Good afternoon, everybody. I'm Dan Hussey from Zaner Ag Hedge, bringing you our strategy of the week update here for January 26th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But as always, if you want to get in touch with me, talk about how we can execute for you, or talk about how some of these ideas can become part of your trade plan, my number there on the screen, 312-277-0110. Feel free to give me a call, shoot me an email, or find me on Facebook and Twitter. Always glad to hear your feedback. Love hearing more about what you guys like seeing in this room, how we can make it better and better produce materials for you. And of course, any kind of likes and comments, appreciate them left in the comment section below. All right, well, let's begin today. Talking about our row crops. I think today was one of those times in the market where we start to see support hold, right? Markets start to reverse. They push through short-term resistance, and of course carry on to find where broader resistance is. Corn and beans, or excuse me, let's begin with wheat. Wheat today. Flip over to our daily chart, and we'll start with the Kansas City wheat, up 21.5 cents. It was the big winner for the day, so to speak. I know March beans up 21 cents. They're almost the leader, but the leaders got to go to KC wheat today, trading up 21 cents in the March contract, 21.5 cents, excuse me, and making its way towards the daily. This is a continuation chart. Well, I guess while that's up, it's good to remember and reflect, how this market got up to 1350, right? We had the Ukrainian war and Russian crisis occur. Well, the Ukrainian crisis, Russians' aggression, and a war occur that drove wheat prices, through the roof, through $10, through 12, 11, 13. Then, we didn't find much more of a news cycle to feed the bull, and wheat prices arguably just retraced that entire amount as, we watched this war grow from, escalation upon escalation, and Russia pushing all the way to Kiev, and then things kind of fizzled away. It quickly became an embarrassment, in my opinion, in terms of losses for Russia. Ukraine pushed them back all the way to some of those borderland regions, and now we're kind of in this stalemate where, honestly, geopolitically, if you look at some of the demographics and such, if Russia commits too hard and too much else to this war, it could be the last war they ever face. They just don't have the population of 20 to 27-year-old men that you usually need of draftable age to sustain this type of war effort. And sending another 200,000 troops to the front to ultimately, you have to assume, die in the bloodiest Russian conflict we've seen since World War II, is just not just not sustainable. With all that being said, wheat prices. What does that matter for wheat? Let's take a look here at the short-term. Not the short term, but just the outright contract, because that's where the moving averages and everything to me matter. Today was the first day that we pushed in KC wheat up into overbought territory, on that daily RSI. This is coming off of oversold from last 2 weeks ago, the start of the month. We've pushed above that 18-day moving average, which has just been resistance for the last week and a half to 2 weeks. Rallied all the way up to that 55-day moving average at 873. Came just pretty close to it. Let's just call that the first test. And we're closing, back in the old range we were in, but generally speaking, putting pressure on resistance. Tomorrow will be a key day. See if we break above that 55-day. If we head maybe up towards the 100-day at 907, closer to the 50%, retracement of this whole range. We certainly could think about that $9 level as resistance, as it was back at the end of December. But, I would argue this is a market that has really been unable to break below this $8 threshold. The summertime lows here in the entire wheat complex, while in Chicago we did go below, we're now trying to come back above. That's a good sign here in the near term. That shows potential capitulation. And really, sometimes we look for these big wicks, or in this context, tails to form, right? Where the market really sells through a level and then quickly comes back above. And if you look at daily and weekly charts, you see that nice big tail hanging out below a candle, right? Well, this is the type of scenario where we have kind of a failed breakdown, right? Wheat has tried for several months to break through these thresholds, and it just can't. And every moment it does, it snaps right back up. That's not a great sign of a trend continuing. That's a sign of a market that's hit a floor. Hasn't bounced too much off of it or started to get up and walk away, but it's picking itself back up and maybe finding a bottom at these prices versus, and certainly a line in the sand can be drawn here, right? We go below $8 in KC wheat, March contract. I think this entire discussion of a floor being formed ends. But for now, we've proven support. We're in a period in the market where we're trying to find resistance. And the various resistances that we see right here at $8.70, the next one at $9, $9.10, and then above that, I don't see much resistance again until that $9.80 to $10 range, the old highs in the 200-day moving average. Okay, Chicago wheat, and we'll look at the smaller term time frames here in just a minute. Oh, and before I move on, I had the line up there on the Chicago wheat. Kind of forgot to mention here on the KC. We've now broken above this trend line against the highs that we've been holding since October 10th, right? The October 10th highs through the October and November highs carried through the December and January highs. Today is the day we broke above that trend line. I would not be surprised to see the market pull back to test it as broken support or broken resistance now as support. In what we refer to, or I've heard referred to as a kiss your mother setup, it's just a line breakout where the market pushes through a resistance, comes back down to test it as support, and if that occurs, it's a buy signal for potential move higher, right? And there's now a low that you can put a stop at, et cetera, et cetera. But again, lots of good technical reasons to think on the daily time frame the market is trying to reverse. But we do need to be a little cautious here because we are into first resistance and daily RSI is starting to go overbought. So that doesn't mean it can't stay overbought. You can see here, the period of August through October, it really was up in that area for a long time. That could be the case here. But if there's ever a reason that shorts might have their first signals to cover, you're looking at it on a chart right now. Okay. And certainly we know there's a very big short position in wheat, right? There's a commitment of traders here that has shown, over the last several months, ballooning, short position that needs to really get unwound and maybe even go back to neutral and eventually flip long. But I don't think we're going to see that type of position flip totally long until we're back above that 200-day moving average at 970 at this point. Okay, but reversion to the mean, unwinding it. Why doesn't it take it for KC wheat to now a move towards $9 or maybe $9.50? That's certainly on the books and in the realm of possibility. Again, I mentioned earlier that the Chicago wheat and the March contract came down to that summertime low. The figure to watch here is around 750, 760. We came right up to it, and we're trying to break back into that old support. And of course, the Chicago wheat with this downward sloping trend line doing the same thing in the case as the KC wheat there, trying to break above that line. Depending on how you draw it here, it's like at it or breaking above it. It's clearly right. The market's looking at it as an indication for potential direction. Now, one difference between that KC and the Chicago wheat, and the reason why I think we still have further to go higher in wheat right now, is that the Chicago wheat is the one that has gotten the most beat up, right? We fell the furthest below that July timeframe or that July low, and are now trying to come back above it. We are not overbought in the Chicago contract yet, so the short covering, in my opinion, still has a ways to run. And that could take us back towards that $8 figure, get us back in the old, range that we were in back at the end of last summer. And this is a very similar idea to we'll look at it in the US dollar here. Wheat broke down through these levels and is trying to come back up into them. The dollar broke out of similar levels on a slightly bigger time frame, but now has fallen back down into an old range. And that's a big reason why I'm still, have turned and flipped our hat from being, bullish on the dollar, seeing a rally and a run up, and now a reversal. We've got to flip our hats now to being more bearish on the US dollar. And again, that's a comment on how the dollar is behaving in the dollar index against other fiat currencies. The way the dollar is acting against inflationary assets is a little bit of a different story. But a falling dollar against the rest of fiat, and we still have inflation in the marketplace against commodities and baskets of goods, is probably the best case scenario for commodity prices to rally and for the dollar to get weaker. It's all the stars are aligning, if you will, right? For those two, not mutually exclusive, but typically interchangeable ideas. Okay, and in the Chicago contract here, the 18-day moving average was broken back above here today. It aligned with that downward sloping trend line I mentioned here at 845. We're back above it. 55-day up there at 773 hasn't been tested. That's the 55-day moving average in both KC and spring wheat have been tested today. We'll take a look at the KC or the spring wheat here in a second. 822 100-day and 901 200-day moving average there for Chicago wheat. So again, we start to see the resistance break. They will now become new support, and we'll start to go test resistance levels back up above us. And I think we've got some upside targets for reversion to the mean and some short covering that might occur to take wheat higher. Spring wheat, $9 is that threshold that it just could not get below or stay below for more than a few brief moments. We never touched that low here from the summertime, so very similar to the KC contract. Starting to go up into oversold bought territory, but not quite there. 18-day moving average at 908, we're back above it. We did test that 55-day moving average as resistance today at 926, 941, 100-day moving average, and the 1010 area are 200 days. So we're starting to get close to the levels that if we break above, short covering can take us on a rally. And I think spring wheat back to 10, KC wheat back towards 950, maybe towards 10 itself, and Chicago wheat getting back above $8 and a rally towards $9 would be my swing-like projections. And if we look at just the Chicago wheat, look back at the rally from August, through October, I would not be surprised to see a very similar type, price action. Although this was a bear market rally, if you want to just look at over the last 6 months how price action has behaved, well, we spent a few months going lower, a few months going higher, a few months going lower. Now we're due for that few months going higher. So again, $9 to $9.50 is not out of the realm of the possibilities here, but we have to be aware we're just starting this climb. And it's still going to have probably some hurdles or little trip ups to get through. Okay, on the 4-hour time frame, let's take a look at how wheat did. We'll just look at the Chicago and the KC here. Look at some of the short time frame levels, and then move on to the rest of our row crops, energy products. We're going to talk about the S&P, gold and silver a little bit. We've got a Fed announcement next week that could be, a news event to consider. But we shall see. So now the 50% retracements from our October highs around 960 down to the 712.5 lows here for March wheat. That 50% level is right around 840. That 840 threshold is this old kind of cluster of, we're going to put a big old rectangle on the chart here from about 836 through 860. So 840 to 860, that 20-cent band. High probability if we get back up there, there's going to be a fight. There'll probably be some resistance, right? Because there's a whole number of traders that were probably selling against these levels that we went through, and now would potentially be support or old supportive levels, right? That were resistance. And with that being said, there's fib confluence there as well. In the very near term, we're up into the full 50% retracement. Chicago wheat from the 798 highs down to the old lows of the month had held a 50% retracement short at 760. You can see, the rally off the lows to that into that 50% level here. Downside targets for that swing short, if you will, on the 4-hour time frame that aligned, by the way, with that downward sloping trend line we talked about last week. We're down into the 702 area. This wasn't like a trade I was advocating. We just found this level on the charts, how it all aligned, and said, hey, somebody short was a seller here, right? And by the way, 702 is a likely downside target for them. Okay, well, it went down to 712.5. Did not achieve their targets, right? That's not a good signal. If a market can't move 2 steps forward, 1 step back, and it can't make it another 2 steps forward, right, into a target, it's just, and then gets reversed and reverses the entire work it did to the downside back to the entry points for shorts from a week or two ago. That is a signal that we've got shorts that we're selling up into from the 760 area from the start of January, basically, that are very likely the fodder if we start to go through for short covering rally. Okay, so this is why I say I see some capitulation here, and the price action down to 712 and the swift reversal we've seen off of it. we're waiting. These shorts are now capitulating, is my point, right? And we can literally see them on the chart and where their level potentially is. Somebody was there keeping wheat from going above 760. And over the next 24 hours, we might see, a test of how committed they are to 760, is my point. And if they fail and they start to get out and cover, that's the fuel to run back up to these other highs at $8. And we know 840 and 860 above us, okay, are right there. So this to me looks like a market that has capitulated. We've stopped going down. We've had multiple failures and complete divergence of the trend lower. Now it's on the bulls to try to short squeeze. And if they can short squeeze and do it good enough and cause enough fear from the shorts, they could reverse that entire commitment that we've seen in the trade to being short wheat. Certainly, the Russian news or the news today that the USDA believes Russia is not going to produce as much wheat as they said they would. I don't know if there's anyone out there that, didn't quote unquote see that coming or didn't expect that. But okay, that could be part of the catalyst for the move today. But truthfully, you look at a chart, there's a lot of technicals here and a lot of other reasons why this market rallied and why we're putting pressure on the shorts outside of, one USDA surprise, right? Wheat exports have been pretty strong. The KC Chicago wheat spread, we're still seeing demand out of that for the protein premium. And by the way, that is not a great indicator for direction of wheat because even in this entire downtrend, we've seen that protein spread, right, gain a premium to the KC. I am getting worried that we're getting to the point where that spread has now widened to an extreme, right? And we might see it narrow. So arguably Chicago wheat has a lot of catching up to do to the rest of the row crops. And I think it also probably has some catching up to do to the rest of our wheat complex as well. But for the time being, my favorite, wheat trading is to be more long the KC wheat. And when you want to sell wheat, sell the Chicago. But that's just because of, the way the KC Chicago spread has been trading, right? But if we talk about some of those intercommodity spreads, wheat to beans, wheat to corn, wheat looks very undervalued. Corn looks undervalued to beans. And that might mean that days of seeing beans up, if we look at a percentage gain here, up 1.4% and corn only gaining 1%, makes more sense to see wheat up 1.5 and 2% respectively in KC Chicago up. Sorry, let me flip over to the other screen where I'm pointing at these real quick. But the idea is we might start seeing wheat be up 1.5%, 2%, beans being up 1%, and corn being up 1 to 1.25%. Okay, so I think that beans are going to slow their pace and rate of rallying, while corn and wheat might actually pick that pace up. Okay, and that's just my comment in on terms of where some of those intercommodity spreads might be. But I don't have any magic science there other than hey, we've gotten a little extreme here. Maybe it's time we start considering what the other way these spreads can go. Okay, so in the short term for KC wheat on the 4-hour chart, and then let's move on. It's a solid 20 minutes on the wheat complex, but I think it's worth it because we are finally at a point where I can say I see the justification for why shorts might start to or want to start to cover. KC wheat, similar 50% level that we talked about there in the $9 to $9.20 is where I'm seeing that resistance, right? There's the old lows here. There's a high at around $9. 9.17 is a 50% retracement of the entire decline. And there's these old highs right around $9. So I think now that we've pushed this downward sloping trend line, we've now pushed through highs of the week, and we're arguably very close to striking highs of the month. This market looks, if it can hang on to the rally and the gains we saw today, as long as we stay above 840-ish, I think KC wheat's on its way towards $9 and $9.20. And above there, then we can talk about a more longer-term rally, right? Getting back to 1050 and some of these other levels. But for right now, could be the start of a breakout. If we do break down back into the old range, below 940, 950, and certainly below 940, I mean, this could all be a fake out, okay? And that's true on Chicago as well. I wouldn't be doing my job if I didn't mention, there are times in the past you can look at downward sloping trend lines and we have these fake outs. But at the same time, at some point markets reverse, right? We've been in multi-month downtrend, multi-month uptrend, multi-month downtrend. It's time, for my opinion, for a 2 or 3 month uptrend at the very least. And we'll see if, how that plans out, okay? So again, we're going through some of those levels. I think there are now lows on the chart, right? Importantly, below $8 for KC wheat, below $7 for Chicago wheat, that we can use to potentially position ourselves to the long side now on a chance to buy the dip, is what I'm really getting at, right? So we'll see how that plays out over this next week. But I think first time in a while we can start talking about the idea of managing risk or coming up with a trade to being long wheat again. Okay, let's do March corn. 682, excuse me. About to scream out 8 for some reason. 682.5, up 7 3/4 cents on the day. Good to see us back, above the trend line breakout we were watching and maybe, looking for last week. I'll try to find a way to get this little drawing that's up there, compressed fib that I can't grab it anymore because it's so tiny. I'll find a way to get that off of there at some point. But anyway, this downward sloping trend line against the highs in the consolidation in this big wedge since June. We're starting to break above that. We're above all of our daily moving averages. 18-day moving averages at 670. I would consider that support now. The 55-day down at 663, definitely support now. The 100-day at 673 and the 200-day at let's just call it 678, maybe 677. Okay, perfect. We're above all those levels, and now we're going to start to, in my opinion, expect to see the 55-day move above the 200-day and the 100-day and the 100-day above the 200-day, yada yada, right? And a complete reversal of all of these so-called death crosses, where the 18-day goes below the 55-day, the 55-day goes below the 100-day, and then the 200-day, which is actually still above the 100-day, which the 100-day closed below the 200-day way back here. When that finally, flips, we have what are called a golden cross. And in this case, every single one of the moving averages, I don't know any other way, but it's kind of like the rainbow that leads you to a pot of gold when they all flip and go the other way. If you want to know what that kind of looks like, just go back to October of last year. It was the last time we had an event like that. Anyway, big pullback in corn for this entire range from 763 highs down to this 571 low. That was a 50% retracement if you draw for basically the 380 lows of the prior swing all the way to the highs. So corn is now consolidated in the top 50% of its range. And at that, it's consolidating in the top 50% of that range. So corn right now is in its top third or even top quarter of price for the last year. So it's quite easy to say, get sales done at these levels because they're, again, out of all the pricing you've seen of the last 2 years, it is in well over the top third of that price. However, we're also at this precipice of breaking out of a trend line. Similar to how we hope wheat is starting to do the same. Corn has already done so. It did so last week. Then had this quick whipsaw back, but we'll look at the 4-hour chart and see how that was just a 50% long of this last swing, held the 155-day moving average, and for the last 3 days has quickly rallied back up to the high end. We go above 690 corn. I see no reason why we're not getting above $7 to $7.10, testing that October high. And then maybe we're talking about trying to close this gap we have up at 734 for March corn. I think that is a very logical next target. And that's not even me needing to tell you we're going to $8 here. Right? There is a nice objective on this chart from where we are, 50 cents higher. I don't need to call for exorbitant rallies right now when all of the market's telling me is that its next 100 days worth of price action is probably going to about this area. Anything beyond that is unknown, and even then what I'm telling you is unknown, right? But there's a high probability for that type of move, in my opinion, now in this chart. And certainly if we get above this 2 months worth of highs and this triple top we've got from today's price action around 684, 685. So 690, call it, breaking out above, confirming more of this move. And honestly, this pullback, the more it looks like it, since basically last week's production of the Strategy Week webinar was an opportunity to buy corn. And I believe we talked about it, buy the dip and stops were going below down here around the 650 area, right? If it was our line in the sand. Still very much a line in the sand, but now I think we can come up to the 660 area. So 660 to 650, we need to hold our breath and maybe think about getting rid of corn longs, because if we do roll over, the risk to the downside is, coming all the way down to that open gap down here at 590. Okay. We can't think about how far corn can go without thinking about how far we've come and the risk of retracing that as well. Right in the middle of no man's land, so I think there's plenty of room to the upside for corn right now on the daily RSI. Simple as that. Real quick, we'll look at December corn on this daily chart, and then I'll go over to the 4-hour chart for March corn. December corn is still very much, I think, in its range, right? I think back above $6 is your key look there. I see no reason why December corn can't get to where the price of March corn is now at $6.80. So that's a dollar rally for December corn. Just to get back up, by the way, to its contract highs and this open gap on December corn up here at 670, and maybe a little one here at 644. But I do think, the idea is we will probably stay above this 550 area, 550 to 540 for December corn, even in the most bearish scenario. But I hope the market does not test that scenario. Very soon here, if we get above $6, I'll be saying the same thing about 580 in terms of support. So I almost like the idea, if we're positioning in December corn here to the long side, or if we're thinking about hedging December corn, let's look at a quick option strategy to do so. Okay, because I think, 590 puts are really where I'd love to get some ownership, right? But if you're not immediately thinking, well, Dan, I don't want to, pay an arm and a leg to own that, to get that ownership here. 302 days left on a December option, right? The 590 put is going to be very expensive. Yeah, 49 cents. Okay. Let's look at the 580 put, 43 cents, 43 and a half. That's a lot of money, but if you want to have a high and tight stop and on production and say, this is where I want my lows, the lows to be. And this is also probably about the worst time to do this strategy, right? That 580 put is going to be a lot cheaper if this rally I think that is coming, right? But this is one to think about and have on your docket, right? Of how can I lock in some protective strategies for any kind of, and this idea of a collar or buying a put and selling a call above is good for any type of long position, right? Whether it's on the board or in the bins, and for any hedger, okay? If we've got a long side exposure in some capacity, this is a means of managing that risk and giving yourself, one, an upside target to hit that you're getting paid for, and two, a stop and a put protection to the downside that is also potentially being paid for. At almost at the money, 10 cents out of the money, 580 puts 43.5 cents. A lot of money to shell out for an option, but you've got 302 days left on it, and you're basically almost locking in right around that $6 threshold. Now, obviously, 540 is your real break even here, but we're going to cheapen that up by the 680 put. 680. If you think, hey Dan, if we were to go to 680 and rally here, I would probably get some sales done. And if you're thinking about that right now, we can almost cut the cost of that 590 put in half by selling a 680 call for 22 cents. You're talking now about 26 cents out of pocket to have real protection at 580. And then, right, to the upside, if we rally, yes, I know the value of that put will go up. But again, our call will go up, but I'm not, and you're short it, I'm not advocating doing this naked, right? I'm advocating this as a risk management strategy if you're a true hedger. So then, lock in then it's just a matter of knowing your own basis and, literally trying to pick the best time to lock that basis with a basis contract. Now you've moved your position from cash grain to the board price. You've got a board position on that has a stop at 580 and a profit target of 680. If we rally up $1, you're making that dollar of gain in your futures position, whether it's in an actual December corn or via a basis contract corn. And you're only paying 26 cents to have that stop under you at 580. at this time. And again, the higher we go, the more money you're going to bring in for that 680 call, and the less you're going to pay for that 580 put. If we find ourselves another 20 cents higher, with a delta at 45% on the 590 put, a 20-cent move is going to cheapen it by, we'll just round it at 50% here, right? It's going to cheapen it down to, okay, 12, by about 12 cents, or I'm sorry, by about 9 cents, 8 cents at worst. You're going to see this call also bring in, with a delta of 30%, another 3, 4, 5 cents. So now all of a sudden you're talking about a 26-cent cost getting down to a 13-cent cost in just a 20-cent move in corn. And of course, you can structure this a little differently, right? If you want that cost, the 13-cent cost now, buy the 570 put and sell the 670 corn. It comes down to a 13-cent cost right there. So, it's all about, right, how much out of the pocket you want to, and working out those scenarios. But the moral of the story is that there's some interesting ways to go about this, and I'm giving you a bearish strategy, right, that is intending to work in a bull market or help you, price things out in a bull market. And as a producer and as a hedger, those are hard things to sometimes do because, right, the market's always going up and you want to always make more. And the second I lock my price, I've locked my price, right? There's nothing there. Well, a strategy like buying a put and selling a call above, of course, if it's covered through long futures or a basis position, affords you the ability to improve on price, but keeps that floor in there at the lowest cost possible. Okay, let's move on to soybeans, our other big breadwinner for the day. And yes, I will get some. We got over a half hour left, so we've got. I will be talking about crude oil, probably bonds, gold, the S&P here, all towards, and with some. We'll move on to the cattle and hogs right after the soybeans here, but we will move on to those other non-ag markets as well. Okay, so soybeans up 21 cents there in the March, only up 7 3/4 there in the November. That old crop, new crop spread certainly starting to get a little wild again. Something that we'll start to continue to pay attention to because, we're already at $1.80 wide on that thing. I'm sorry here, $1.52 wide. I don't know how that math works out because I'm seeing. Anyway, it doesn't matter. Because I'm looking at, this is July. I get it. I gotcha. Yeah. July NOV here is at $1.52 wide, right? If we looked at March NOV, we're $1.70 wide. I'm looking at 15.23 and 13.52. I'm like, that's not $1.50. But say levy. It's a different contract. Yeah, so we are breaking out to new contract highs on these. This is a spread that it's funny, I saw a nat gas trader that I respect on Twitter. She posted a joke about how the Widowmaker, a spread in natural gas, had moved on the open 23 cents or something crazy, right? A massive move in the spread, basically like wiping out all the carry in it, in just the open. I joked, around that tweet saying, well, it's funny how every futures trader, depending on the market you focus, we all have a different Widowmaker. This July NOV spread is the Widowmaker to me. It's the one where, it can be trading 50 cents over and a couple months later be $1 against you. And you just kind of sit there shaking your head like, how did that even happen? Here we went from $1 over to $1.52 over in just a matter of days, in a couple of weeks. The month of January has been one of the biggest months for this spread to date. And in the tightest of carryout years, historically, this spread can get as wide as $3. It's settled around $2.50, I think, wide back in 2013, 2014. I forget the exact year, but I've studied 30 plus years of historical data on these carry spreads and old crop, new crop spreads for that very reason, trying to draw out the correlation between carryout and how wide these spreads can get. And I can tell you, this is the type of situation. Multiple years of 200 bushel carryout for soybeans leads you to having these spreads at $1.50 to $3 wide. It's just the way it rolls, which is another reason why I'm bullish on those new crop contracts coming up, but I think there's going to be a lot to chew through, because these spreads will unwind at some point. And when they do, I doubt it's going to be, November coming up, like literally being up 5 cents while, March and July are down 10. It's usually just, that November doesn't really rally anymore, and it kind of holds support or doesn't fall apart while the other ones get, crushed. And if that happens, it's going to limit the upside here. And unfortunately, I think these spreads are starting to get to the point where, very similar to our corn wheat spread and our beans corn spread, and very similar to the protein spread, which I didn't look at that, but just for a second, July wheat here, protein spread is at 85 cents over, getting popped up to a 90-cent over. Looks to me like the trend that's going higher shouldn't get back below 75 now. If we're going to continue higher, probably as high as 80. Excuse me, if this is going to run above $1 over. It definitely can. July here is at 85 cents over. March wheat is at $1.11 over. So it, went above these thresholds, came back down to test 80 cents over. Now it's going back above $1 over. This spread would have to go to $1.30. The July would then, be going to $1 to $1.10 through its new highs. And if you notice, the July is already making a new contract high, whereas the March to March is just getting back to the top third of its price near contract highs. So in other words, those deferred months are certainly starting to pick up the pace to catch up to where these spreads are. But the lack of this front month spread at $1.11 tells me we're probably getting to the point where $1 to $1.30 over for this spread is about where the market says that's too wide. Okay, we should look for, we're using that same logic applied to old crop, new crop spreads for soybeans. We're probably getting to the point where we might be a little too wide here, but I'm not willing to, just say that. So if that's the case, we should look at the March soybean to November soybean spread. Did I type that spread incorrectly? Let me see. Give me a second here. Waiting for data to populate. Oh yeah, I did not type that in right. Now it's typed in right. There we go. 171 over. Yep. All right. Yeah. This is just we don't have much price action to sink our teeth into. Both these spreads are okay. Actually, we're seeing something very different here, right? We're seeing the March to July at 14 cents up on the day versus the November to July, or July to November. March to November is up 14 cents. July to November is up 8 cents. That stands as a stark difference to what we're seeing in those protein spreads, right? If we're using the spreads as a barometer for what's going on elsewhere and how wide we're getting, we have not found that top in soybeans, right? The near term, wider, more volatile spread is still up 14 cents on the day, as we would expect in a bull market compared to the old crop, new crop spread of July, November, which is up 8 cents. Both breaking to new contract highs until we see this near-term March to November start to back off, right? Both of these will probably continue higher with March outpacing, which is why one will get to $2 before the other, and vice versa. So, okay, kind of a look into how bullish can soybeans get. Well, the spread markets say we're not done yet, or we're at kind of peak bull velocity right now. And if we look at the 4-hour charts and break down just the outright futures, let's see what they have to say. So up 21 cents here, right, in our November beans. The capitulation, or I'm sorry, the sideways range that we had in soybeans, which is very similar to the range in corn that we've been talking about that we're just starting to break out of, right? Downward sloping trend line against the highs, upward sloping trend line against the lows, kind of made its mark in November, and we started to break out of that trend line here into December. If you notice, the first time above it, we had a multi-day pullback to about 50% of this range, right? It's kind of slack leg up before breaking back above and continuing higher. This now, what we're watching play out on the chart as it moves forward is kind of how I expect corn to go now, right? Breakouts, pullbacks to test support, breakouts to pullbacks to test support, but generally speaking, a series of higher highs and higher lows in terms of swings, even if, on the daily candles, that wasn't necessarily the case. So I think it's pretty clear we're in a range here between 1470, 1480, and 1540 on the soybeans, and we're just right back up in that range here and back above that 18-day moving average, which has been a reversion to the mean that this market has made. So every time we break above it, we come back down to test it. We even go below it, come back up to test it, go above it, yada, yada. We're using it as more of an average of price rather than a trend indicator for price. The 55-day moving average right now is what's coming in as support, it looks like on this chart, at 1476 there from yesterday. Front ran it a little bit with that low at 1478. We got to oversold here in the daily RSI, and now we're back to neutral territory. So there's definitely some room to the upside for soybeans if it wants it, which means that this 1440 high is definitely in striking range. Fort high area, right? The actual high is at 49, but there's a high here at 38, a high there at 49. 1440, just the threshold, right? If we push above, it's kind of going through resistance, right? And we're also continuing to hold that upward sloping trend line against the lows, which means that now that these downward sloping trend lines are dead in the water or dead on arrival, however you want to look at it, I start to put them against the highs of the chart as a channel going higher. We just kind of shift the dynamic. And at this point in time, I think you can make a case for some channel resistance if it starts to go through the highs, up towards the 1565 area, aligning with our old contract highs, and why not, a test of 1600 at that point. To get us, to 1650, $17 and above, to make this, an all-time high for the crop for soybeans, I feel like we're going to need some other real news and catalysts to feed the bull. We're going to need weather markets, a bad planting season, all the things and narratives we'll see over the next couple months, and of course, continued exports to China primarily that we can rely on, which they've been strong, right? We got China buying cotton, we've got them buying soybeans, we've got them buying corn, we've got them buying crude. They're even taking good exports of wheat. China's reopening. There's no reason, in my opinion, to be very bearish these markets right now, given that fundamental ideology, but we'll see. Doesn't mean they have to go up, right? All right, soybeans on the 4-hour chart. Maybe we won't make it through everything I wanted to, but that's okay. Not much to really say here. Next in the series long we are looking at is a swing from 1412 up to 1536. Held as support, we made it a new high, held as support again, upward sloping trend lines are occurring there. We're flirting with trying to break out of this old summertime high around $15. We're doing so. Now I think the breakout of 1540 needs to occur to 1580, and probably pull back towards 1540 before onwards to 1600. It's just a market that is trending in a very choppy trend higher, but it is a trend higher. Any kind of breakout has a probability of accelerating and becoming kind of a blow off top. So be aware of that. But at this point in time, it's a nasty looking trend, but it is a trend. Kind of all I can say to it there. And every time we ratchet a little higher, again, looking at ways to bring up the puts, sell calls above for protective strategies is a good idea. And still buying the dips against these trend lines and prior range lows is kind of the trade. All right, lean hogs. Not much to say about it here, but each and every contract in the lean hogs has seen a little bit of a snapback here today. June going down to test that $100 level, tested the 50% retracement here lows, and we're back up to kind of a trend line resistance against the highs at 103. April hogs, a little different of a chart, but coming off of their lows around the 84 figure, there it is, had retraced 100% of that same decline, and now have put in kind of a key reversal or outside day to the upside, a bullish engulfing pattern Want to see a gap fill here of 88 on the lean hog. And 18-day moving average at 88.50. I think there is a little bit of upside here with next resistance into that 88 area. That's where I'd be interested in taking profits for any longs here in the last couple of days, or maybe even being a seller. But I don't know. I want to see how it trades up into there. Cattle, live cattle, 18-day moving average at 157.25 in that August live cattle, 156. 55-day moving average, 100-day down at 154, and 200-day down at 152. Those levels all coincide with different fibs, whether it's a 50% retracement from 147 all the way up to 158, comes in right around 152 with that 200-day. 50% retracement from 149 up to 158 comes in right around the 154 area in the 100-day moving average. And yeah, there's trendline support basically that comes in right here with this and this channel support from a channel if you draw it against the lows and the highs here at 156. The 100-day or 18-day moving average, now that we're above it, could be support and, on a move towards 160, which up at 160 is not only starting to get into that territory where live cattle has traditionally started to top in the continuous contracts, but is also a trend projection from our trend lines and some fibs up there. So yeah, I think while we're above 156, we're trying to put a move up towards 160. And this is a market that's just trending higher inside of a channel. We're right in the middle of the range for, RSI, daily RSI coming off of oversold. So I still think there's room to the upside here, even though today is our first day of lower lows and lower highs we've seen in a week. Markets don't head in a straight line. So if tomorrow and into, next week, we see that push above 158, going to 160. But, notice I'm not calling for more than about a $2-3 move higher in cattle, because unfortunately I do think we're getting closer to a top than, to a bottom at this time. And I have kind of shifted the focus out towards August, just, taking us out, to the 200-day cycle, where, if we take a quick look at February cattle here. There you go, trading at 157. It's pretty much the exact, same trade, right? Every chart I just taught, I don't know why my chart wants to do that. Zooming out here, it's a very similar trade. From that swing low to high, comes in at 153. 155 is where the 100-day, 100-day, 55-day is at 156. And today was actually a failure to break above that 18-day, but nevertheless, the February cattle is not exactly, kind of rolling over a little bit more so than that August there. And it might be a precursor to kind of like, the near term isn't quite achieving what it should, and the deferred is, of course, getting spread against. So if this one rolls over, I think it's going to be hard for August cattle to really continue its rally as well. Is that, what I'm really getting down to, right? All right, real quick, the dollar index. And then we'll take a look at crude. I mean, there's not much to say about crude, precious metals. The bonds are, well, the S&P I could actually talk for days on right now, and why you need to be a little bit more bullish than you might be. But this isn't a continuous chart, but it shows you generally you can see this lack of liquidity here for the March contract. But the dollar was down here below 100. We've rallied above all the way up to 114, and now we're retracing that entire rally and falling back into the old multi-year range, which is basically from 80 to 100. Okay, this whole reversal looks like a big old rounding top, or big capitulating or blow off top, I should say. We are oversold on the daily time frame, but notice we've been oversold now for several weeks, and we can remain that way. It's not going to take much to bring us back to neutral at this point. A pop to 103 would do it, and then, I mean, that would just look like a bear market rally to sell into one more time for, lower price. The dollar trend is lower here. 18-day, 55-day, 100-day, 200-day moving averages all starting to roll over. I see no reason why you need to bet on the dollar reversing sharply from here. That wouldn't be a counter trend trade in the near term. That I would be advising you to maybe sell into that rally, up into that 200-day moving average around 105 if it gets there for a reversal lower. But who knows? I definitely am looking for reasons to be a seller in the dollar now. I've shifted that hat, and we're going to try to ride this trend to the downside, which would bring, I think, generally speaking, commodities higher. All right, let's flip over to... Okay, let's look at crude real quick. Again, daily chart of crude here, 80 to 70 range we've been in. Not much else to report. Big 50% retracement at 68 from our COVID lows to the highs. Notice the COVID low here is not negative because the front month crude wasn't actually negative at the time. We went down to 650 in the front month futures contract, but the deliverable contract at the time did go negative, and that was because of what happens with deliveries. But with all that being said, this market has pulled back into that 70 area, a widely talked about area that the U.S. would start rebuilding its strategic oil reserves at. And certainly, you're going to vocalize like something like that. I think the whole market's going to say, okay, well, we'll buy it here too. You got this backstop of the U.S. government to buy crude. I mean, come on. It's almost a no-brainer why we haven't gone below 70. Not that I took that trade personally or making money from that idea, but like the logic there, it makes sense, right? Like they say don't fight the Fed. Well, don't fight the U.S. government when they're buying crude either, I guess. Could be something else to be said. And likewise, don't fight them when they're selling crude because they started selling, right? And arguably, you could make a case for this downturn having been because of some of those sales, right? Whatever. We're really just breaking out, in my opinion, of this old cluster of resistance between 67 and 83 that happened 3 times back in 2021. 2022 is the breakout of that level. We've come back down to test old support now as resistance, 50% retracements. This is a market that's taken 2 steps forward since the COVID pandemic, 1 step back, 2 steps forward will take us to $150 crude. If we continue with that idea since March of 2020, which I feel like there's more reasons to think you should, then we won't. The next 50% retracement, though, in the stair-stepping lower, much like the other charts we're seeing, like wheat here, these 50% levels from, in this case, a November high down to the December lows have been sold into around the 82 figure. At some point, all the stops that have built above 82 are going to be the fodder for a move to 86, 88, maybe even as high as 92 to 94. So downward sloping trend lines around 85. I think it's a long ways off to wait for a break and, buyback of a rally. But been looking at in the crude, going out even as far as July here, you can pick up some $10 wide call spreads in crude for like $2,000, $1,500 to $2,000. That's risking $1,500 to $2,000 to make $10,000 if you're right. And those call spreads aren't that far off. We're talking like 86 and 88 calls and selling like 98 or 100 above it. The 90-100 spread was one I looked at. 92, 90, 102. If we think we're by next summer going to make it to 120 crude, that's a great way of starting a position in the market that has finite risk. Has a little bit to do if crude goes lower. You can always buy back that short call, roll the long call down. There's management that you can do to the trade, but also it's survivable. If you only spent $2,000 on that call spread, you can't lose any more than that $2,000 you spent if you don't do anything, right? It has the opportunity for success, and it has the finite risk of loss built in. So until we see a clear trend develop in the futures, if we're trying to position in crude in these bigger levels, I think a call spread, a $10 wide call spread for around $2,000, maybe $2,500 if you bring it close to the money, is where you want to live. Get that 5-to-1, 4-to-1 risk-reward ratio. And it's certainly a strategy that you can survive the next 90 to 100 whatever days, however long crude has. Let's take a look, right? 139 days on those July options. Hey, let's just look at them real quick. The $90 call is going for $4,400. Selling the $100 call brings in $2,150. There you go. There's your $2,200, whatever it is, $200, $300 call spread, 139 days out, right? I think that is a viable strategy that is survivable that you can be a part of for the next several months and not have to worry about it. Okay. Bond market today, I think we are entrenching in a bit of an uptrend here. Yes, I think the Federal Reserve may hike as much as a half a basis point, but I don't think it's going to be enough to really spook this market. We have Volcker-like inflation. If you know who Paul Volcker is, it's worth a Google search. We have Volcker-like inflation, but we don't have a Volcker-like Fed, and that's the big difference here, is the Fed was late to act, and they have not done enough now, in my opinion. By the time Volcker had peaked with his hiking of interest rates, they had done considerably more, considerably faster than what we're doing now. But there's also things to consider, like much bigger monetary supply now and other things. But nevertheless, 131 handle seems to be resistance here in the bonds. It's the old support, now resistance, the 50% retracement from 145 swing lows to highs. But we are breaking above, this downward sloping trend line against the highs that we've held the last several months. And we did hold a 50% retracement from the 117 figure up to 132 at 125. So you've got a battle over the trend here in the bond market that I truly believe we could see both sides of this range test a couple more times. So resistance now is at 132, support's down around 125, and I believe that we will continue to see a fight over this trend. Again, if we don't fall back into this range and down to 125, then there is definitely an upward sloping trend line here. There is pressure we can put on to take us to 136, but I'm not flipping my total trend on it until we get up to 136, and then buying the dips is probably advisable. Until then, there's a bit of a double top here, a Fed meeting next week. I would not be surprised to see another push down towards 125 on a half basis point rate hike. But then I think support will probably come in here and take us right back up to 130. And if that's the case, we might actually see a push, higher. And again, we got a long way up, right? This market can retrace all the way back to 154 just because the market got too short. That's all. Doesn't matter what actual interest rates are doing. They could retrace that far. What the Fed's doing with interest rates. Obviously, this would denote what is happening on the paper, but we could get up there. And certainly, if the Fed decides to not do enough, we could get up there. So keep an eye out on it. But the bonds, I think, are due potentially for a little pullback with the resistance we're seeing. And we're going to want to see that confirmed here in gold. The chart of gold has actually kind of diverged from the bond market here recently. We've been kind of bullish gold. We were fearful of this 1850 area, which was a full 50% retracement off the highs. We've now broken through 1900. So now, it's the long side we're looking for. Pull back towards 1875, I think, could be on the table, or even deeper towards 1780. But I'd be a buyer in those dips in some degree or some capacity. What I don't like seeing is this kind of slowdown and divergence here, but it is an uptrend until it's not. But with the FOMC next week and the rally we've seen, I would not be surprised to see gold have a pullback on whatever the Fed decision is. But I do think it's worth thinking about buying the dip there. But again, as long as we don't push through the highs or change these levels, 1870 and 1780 are the two big levels I'm looking at. And last but not least here, the bull market that is climbing the wall of worry. Full 50% retracement shorts, the 4,200 level, certainly where we're looking here on the daily chart of the S&P. We're breaking above trendline resistance, a lot like wheat. Went up above it, took out stops, came back down, held a 50% retracement from 3,500 up to the 4,180. That held around 3,842. We've now held another 50% retracement. That was from 3,788 to up to the highs. That held around 3,910. Upside targets, 4091 is next. Out the breakout above this, I'm seeing us go to 4,200. And ideally, if the market can get up to 4,340, we might actually have a reason to think that this market has bottomed 2 months perhaps before, or 2 quarters before a potential economic recession, which is statistically when the S&P 500 always bottoms. The full 50% retracement from 2180 up to 4800. All right, that's the COVID low to COVID highs, just like crude oil, holding at 3,500. Upside swing from there could take you to 5,400, and of course 6,400 over the next. That would take a couple of years probably to pull out. But that's the daily chart that we've been watching. Tweeted about this trend line break and how I wouldn't be fighting and trying to sell into this stuff anymore, because to me this looks like a market that is ready to rip your face off and rally above 4,200. We'll see if that plays out, but so far today we're continuing that trend higher, and I believe risk on is the name of the game. Thanks for joining me, everybody. That concludes today's Strategy of the Week webinar. You can always be reached over here at Zaner at 312-277-010. Find me on Twitter, Facebook, or shoot me an email, dhussey@zaner.com. Thanks for joining me. Leave your likes and your comments in the sections below here on Facebook and YouTube. Of course, sign up for this webinar and get the recording every week, because this webinar will become private here after February 1st. So the next one we'll do will be to that mailing list only. You can, of course, join me on Twitter and on Facebook at DanSOTD, where I do put out daily, more shorter time frame updates on some charts. But hey, join me for this weekly webinar. It's free. Sign up in the links below, and love to have you on board. Have a great day, everybody, and we will be back with you as price action develops. Take care, everyone.